guess move over Elon Musk. As we first mentioned on Tuesday, China's BYD has dethroned Tesla as the world's best-selling electric vehicle maker, selling more EVs last quarter than ever before. Experts say that the trend could continue into the next year, which is this year. Tony Waterman has more from Austin, Texas, where Tesla has its HQ.
This dethroning seemed inevitable because BYD has been steadily moving up the EV ranks for a while now. It has really become a turn-to for consumers looking for cheaper and smarter EVs. But toppling Tesla is a major feat, and it was something the Chinese automaker was keen to highlight. In a statement, it called itself the world champion for new energy vehicles after selling a record number of EVs in the fourth quarter of last year. It sold more than 526,000 fully electric vehicles, which was enough to outpace Tesla, which delivered just shy of 485,000 EVs, which was also a record. Tesla did manage to keep its spot as the world's top EV seller for all of last year, but experts say that could shift in 2024. For one thing, Tesla is losing market share as automakers, new and old, pile into the EV market. Higher interest rates are also driving up borrowing costs in the U.S., which is one of Tesla's largest markets, and the company has been slashing prices to woo buyers, a move that could ultimately eat into profits. BYD, meanwhile, is expanding rapidly. Sales of its pure EVs grew 73% last year, in part helped by strong support from the Chinese government, which has made the energy transition a top priority. And while the cars aren't available in the U.S. right now, BYD is making significant inroads in Europe. Just last month, it announced it was building its first passenger EV factory in Hungary, giving it much easier access to the bloc's 450 million potential consumers. And BYD has a major advantage many of its competitors do not. It completely controls its supply chains, from the mines to battery and semiconductor production, which means it's only going to get harder for Tesla to maintain its pole position and for other companies to overtake BYD. Tony Waterman, CGTN, Austin, Texas.
To the markets in New York, John Terrett has more.
On Wall Street on Wednesday, there was a sell-off in the last hour, and I think it probably wasn't helped really by publication of the minutes of the Federal Reserve, the central bank, from their meeting of the 12th and 13th of December, when you'll remember they left interest rates on hold, and there was a very, very big clue from the chairman suggesting that there would be interest rate cuts in 2024. Well, the markets loved that, and there was that strong end to 2023. Well, today we got to see what they were actually thinking about, and it turns out the committee is pretty convinced that rates are at or near to the highest they will be in this cycle. They did cite the possibility of interest rate cuts in 2024, but no date. No indication of when that might be. And they did also suggest that rates could remain elevated here if inflation doesn't continue on its downward path towards the target of 2%. Now, Wall Street's not particularly rattled by this because they think inflation is on the way down. They think rate cuts will happen, mainly because it's a presidential election year. Nonetheless, on the Wednesday session, we finished in the red again. The Dow was down 0.8%, the Nasdaq 1%, S&P 500 0.8%, Bitcoin was down 5%. And on Thursday, we'll get a look at the weekly jobless numbers and the private jobs numbers ahead of the big government report for the month of December, which is released early in the morning here on Friday. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on the U.S. economy and what we can expect for the new year or this year, we're joined by Matthew Maley, the Chief Market Strategist, Miller Tabak Co, founder of the Maley Report. Good to see you. Welcome to the show from Boston, Massachusetts, it says here. You know, we ended last year on this huge, enthusiastic mood about the markets. And now we're, I guess, I saw we're 0 for 2 on the couple days of trading. We saw the Fed minutes today. What should investors expect for the economy right now?
Yeah, one of the things we have to look for is, are we going to see this improvement in the economy next year? And because the stock market, as you mentioned, it rallied so strongly at the end of the year, almost in a parabolic rally in the last 2 months, that people are questioning them: is 2% 2% GDP growth really going to be enough to push it a lot higher? We have a market that's trading at 20 times earnings. So if we get this, 12% earnings increase next year, is that already built in? And I think that's what some of the pullback of the last couple of days has been worried about, is that maybe we went a little bit too far, too fast, and are taking away a little bit from the fundamental gains that we do expect this year.
So, sometimes I think we over obsess about the economy, whether it's growing at 2.1 or 2.2 or 3.5. At the end of the day, when investors are buying stocks, you're not really buying into the economy. You're buying into the future cash flow of companies, right? What a company might be worth over the next 10 or 20 years. And what we saw for last year is that in spite of rates and all the problems that we talked about, profits were good, margins were good, employment was strong. What's there to worry about?
Well, I mean, there's a couple of things. First of all, is that we have this, the market is getting ahead of itself to a certain degree. As I said, it's getting expensive. This one thing with interest rates having risen so much for so long, every single time that's happened in the last 50 years, it has caused a slowdown. Now, I do think, it's a presidential election year, so everybody's assuming that we're going to have good, strong growth next year, but that's not guaranteed. And I guess the thing that does have people worried about right now is that at this time last year, everybody was wildly negative on the market, and of course we ended up getting a great year. And right now, everybody seems to be wildly bullish. At least they were 2 days ago, going until this most recent downturn. And so you worry about that. There's too many people on one side of the boat, and it really doesn't leave a lot more upside here. So there are some concerns out there on my part about the sentiment that exists right now.
If I told you a year ago that the 10-year would be around 4%, okay? Ignore the 5% for a minute, but let's just say I told you the 10-year would be at 4%, and yet the markets would be very close or near all-time highs. What would you say to that?
Yeah, there's no question I would have thought that was absolutely crazy. But we also have to remember, too, that a lot of liquidity has been pushed into the market. It definitely started during the regional banking crisis of last spring. But, if you look at even though the Fed's balance sheet has shrunk, the assets that are parked in the Fed's at the Federal Reserve banks has been actually rising all year long. And so if that liquidity doesn't stay really strong, it's going to be much tougher for the market to hold up. Liquidity is a very powerful force, as we've learned since the great financial crisis. And if that becomes less plentiful, we do have to be a little bit concerned about it.
But isn't this the same wolf crying that we've heard in the past? We know there are trillions in the economy just waiting to come into the stock market, whether they invested in bonds or money markets. I mean, after all, look what tech stocks did. In the face of all this bad news, tech stocks had one of the most amazing years, I think, going back to 1999, which maybe is not the right reference if you remember what happened in 2000. Let me start with the Teslas and the Microsofts and the big sevens of the world. Should we be buying those, or should we be selling those? Because if you go with what the market trends have been, buying the most expensive, biggest cap companies have really been the way to go.
Yes, but a lot of them are a lot more expensive than they were, of course, 6 months ago or even 3 months ago, and they're up to levels where they usually don't go a whole lot higher, except in the late 1990s. So we do need to be a little bit worried about that. And there's some stocks going to be I think you want to continue to buy. You look at an Nvidia and a stock like a Palantir, another one of these AI stocks that has done quite well, and of course they've close ties to the government and government contracts, which if for some reason we get a hard landing this year by a surprise, that's going to help them out. Then you look at a stock like Salesforce.com, which is a great company, and got good prospects, but their CEO Mark Benioff has sold hundreds of millions of dollars of insider sales in the last 3 months, and you wonder, believe me, he still owns billions of dollars of stock. But you just wonder if they think that these stocks are getting a little bit too frothy for their own good, and they're taking some chips off the table. So I guess my point is people just want to be a little bit careful about chasing these stocks right here and look for it, see if maybe get a little bit more pullback before they add.
Two of the hottest sectors last year, we talked about AI, electric vehicles. Elon Musk is in both of them. You may not follow him very closely, but I'm curious, are you a Tesla fan at all?
Well, I mean, betting against Elon Musk has never been a good idea. So I'm a believer, and I think Tesla will do very, very well in the long term. Where they're really going to do well, is this whole driverless car thing, and that's several years away. That doesn't mean we can't start buying in anticipation of that, but there's a lot of fits and starts, and we know from some of the issues that have happened in San Francisco, where they're testing these vehicles. They've done very well to a certain degree, but they have a long way to go. Where you have BYD, which, as you were just explaining earlier, that how they're making these inroads into Europe. I mean, not only building a factory there, but they're starting to get partnerships with dealerships in Europe. So they're trying to make some big inroads there. The good thing for both of those companies is that yes, we're worried about competition, but boy, the GMs and the Fords of the world are not doing a very good job at this, and they got a lot of catching up to do. So both of those companies, I think, will do well over the long term.
Matthew, it's going to be a fun year. We're just getting started. Appreciate you. We'll have you back again. Thank you.
Thank you.